Okay, so good afternoon, everyone. I'm Alberto Rossi, Associate Professor of Finance and Associate Director of the Center for Financial Markets and Policy here at Georgetown. Welcome back to our seminar series on FinTech. Before we get started, let me remind everyone of our annual conference, which will take place over the week of November 16th. You will find more information in the chat. Let me also thank the Director of the Center, Marina, the Executive Director of the Center, John Jacobs, and the Assistant Director of the Center, Anna Kormis. Today, I'm extremely excited for Natural Language Processing Day. We have 3 great papers that use N.L.P methods to either predict stock returns, identify the effect of fake news on financial markets, and measure the extent to which risks are neglected in mortgage-backed securities. Without further ado, let me leave the virtual floor to Dacheng, who's going to present the first paper. The paper is titled Predicting Stock Returns with Text Data. As a reminder, Dacheng will talk uninterrupted for 20 to 25 minutes. We will then have 5 to 10 minutes for questions. You can either raise your hand or write your questions in the chat. And just to make the presentation more kind of engaging, if all of you that are happy to kind of turn on your camera, please free to do it. Feel free to do it. It just makes everything more engaging. But Dacheng, the floor is yours.
All right, thank you very much, Alberto, for the kind introduction and for inviting us to present this paper. It's a joint work, it's a joint work with Tracy Koh from Harvard and Brian Kelly from Yale. All right, so on February 4th, 2016, MIT Technology Review published a very interesting article titled, "Will AI-Powered Hedge Funds Outsmart the Market?" So in this article, there's a very nice paragraph which I quote here. So one of the most promising uses of relatively new AI techniques may be processing unstructured natural language data in the form of news articles in an effort to glean insights into the future performance of companies. So this article nicely summarizes what we want to do in the current paper. So why do we use AI? Well, in particular, machine learning. Well, the reason is the numerical representation of text as data is in principle very high dimensional. So to give you some perspective on this, we're going to analyze over 10 million articles with over about 30,000 terms as explanatory variables. Clearly, some high dimensional analysis is required to understand the data and to avoid overfitting. And machine learning offers lots of tools to tackling high dimensional statistical problems via dimension reduction and variable selection. And it's naturally, we need machine learning to do this. All right, so if we look at text analysis in the industry, it seems clearly that N.L.P and machine learning in particular become increasingly sophisticated. And there are a couple of funds that are actually mentioned in the MIT Technology Review that are specialized in AI. So one of them is Sentient. And in the meantime, there's Ravenpack, Refinitiv, Bloomberg. They provide very good analytical tools for fund managers to use. If you look at the common approach, among this industry, among the practitioners, it seems like deep neural networks becomes very clear to be the leading tool used by many of these players. And in particular, on Sentient's website, they said they're using evolutionary intelligence technologies, deep learning algorithms, and enormous stockpiles of data. So it looks like they have all the keywords that indicates that they're using kind of deep neural networks and etc. But in terms of the performance, this fund was liquidated just after 2 years. So clearly, we are not very sure about, how successful deep learning and in particular other natural language processing tools would be useful for investment purpose. So now, if you look at text analysis in academic finance, the usage of text analysis is still in its infancy. Most of us are looking at sentiment of a document where sentiment is put in quotes because, we are essentially analyzing the tone of news instead, or some other document instead of, investor sentiment, etc., which is a more complicated notion of sentiment. So we're gonna do this as well, following the literature. And if you look at the common approach, it's quite, innocent in the sense that it's very simple, but in that regard, it's very transparent. So the idea is basically trying to, first of all, figure out a dictionary and label each word in a document to be positive or negative, and then aggregate these, individual word sentiment scores to obtain a final score for each article. And typically, these approaches also do some regression analysis that associate the sentiment scores with certain returns. And most often it's the market return. And most often it's the contemporaneous market return. You find a strong statistical association. In terms of prediction, you might find statistical significance for market return prediction, but still there's no clue that the huge transaction cost would actually make this trading strategy profitable. So clearly, there are these two extremes, right? So on the one hand, you have fancy deep learning. On the other hand, you have a simple counting words approach. Seems like neither approach can be very convincing about whether N.L.P can be useful in asset pricing in investment. So in our paper, we'd like to provide a non-trivial benchmark, but in the meantime, it's not a black box. All right, so that when someone else proposes deep learning algorithms, maybe ourselves as well, so we can actually use this model as a benchmark. So we can actually model how news are generated and how sentiment is embedded. So this is very important for us to understand the statistical limitation of doing N.L.P. Because we need to understand under what conditions that we can recover sentiment and what is sentiment and how we estimate that and how to do simulations, things like that. So instead of simply running a regression of A on B, so that does not really tell us the limitation of this approach from a theoretical point of view. In addition, we like to consider different contexts demand different notions of sentiment. There shouldn't be a universal dictionary that works for all kinds of sentiment in all scenarios, right? So if we were interested in returns prediction, we probably should use words that are most indicative about returns. And in this regard, it's very important to use a supervised approach to guide us in an N.L.P setting. Even though in the literature, that we follow, most of N.L.P techniques like topic models, LDA, etc., are actually unsupervised learning. And in the signals noise, in the financial market prediction, the signals noise ratio is rather low. So it's better to have a supervised approach whenever possible. All right. So in addition to these advantages, we kind of translate all the statistical gains into economic terms via portfolio performance. And this is particularly a weak point of the literature where we haven't seen convincing performance based on N.L.P techniques. All right, so let me discuss the model and the data. So it's very simple, and there's basically this one slide that summarizes everything. So we assume that we have a vocabulary of M words. So think of M being 30,000 or can be even more than that. And we believe that these words belongs to two disjoint sets, set S and set N. So set S is sentiment charged words, and set N include sentiment neutral words. So for example, a word like shortfall, surprise, jump might belongs to set S because they might be indicating a future performance of a company, versus book, water, air, words like that should probably in set N. So we're not going to predetermine which words belongs to which set. We're going to let the data speak. All right, so in addition, we have a sequence of events and documents. Think of this as news. And we have like 10 million news. So it's a very large N. And we represent each piece of news by its word count vector DI. And DI is M by 1 vector with word count. And as you can imagine, it's going to be a very sparse vector, meaning there's lots of zeros in DI. So in addition, we're going to have a corresponding label for the news provided by the reporter And with that information, and along with the publication time of the news, we can come up with a return, that will work as our label to guide our learning process. All right, so we're going to have two assumptions that would allow us to learn the sentiment from DI and RI. Those two are the only observable quantities in our model. All right, so we assume that each news event has a sentiment PI, which is between 0 and 1. And 0 means negative, 0.5 is neutral, and 1 is positive. And we believe, what makes sentiment a sentiment is the following assumption. So we believe that as the sentiment score increases, there is a higher probability of realizing a positive return. So this is the only assumption we made, and we are not making any assumptions about magnitude of the return and how it relates to the sentiment score, because we don't want to deal with factor models, Barra and that kind of stuff in this setup. In addition, the function G, which is the increasing function, we're not making any assumptions about whether what kind of function form it takes. Is completely we're completely agnostic about the functional form of G. It's not used for our analysis. All right. So I hope I have convinced you that this is a very weak assumption that defines the sentiment in our problem. So in addition, we're going to also have a text probability structure that links sentiment to the realization of word count. All right. So in particular, we make a very weak assumption only on the word, only on the entries of DI that corresponds to words belongs to set S. So this is the meaning of notation subscript bracket S. So we're going to look at only the rows of this vector DI that corresponding to words in set S. All right, so we assume this word count vector follows a multinomial distribution where the frequency of word count, frequency of words is kind of modeled as a linear combination of two vectors O plus and O minus. So O plus and O minus are supported on set S. So their dimension is typically small, right? So you can imagine set S has a much smaller dimension than set N. So typically 200, 300 words. So O plus, O minus are lower dimensional the parameter vectors. And if PI is 1, then O plus totally determines the distribution of words in DIS. Otherwise, if PI is 0, O minus determines that. So in general, so it's a linear combination of O plus and O minus that determines the word frequency in DIS. All right, so this is the whole model. And our goal is to learn in sample O plus and O minus. All right, so this would tell us how to weight individual terms to aggregate, to give an aggregated sentiment score for an article. And auto sample, we're gonna learn PI for any new article that arrives. All right, so let me give you an example. All right, so, and this is IBM example, and this is how our human being read this article, right? So, but when we feed this into a machine, and we have to do some basic data cleaning, and finally, we translate this to a bag of word, or DI vector. This is a very long vector. And as you can see, lots of words, there's about only 160 words showed up in this article. And the most frequent word is say, which appeared 11 times. This word might not be really, critical about the future performance of the company. All right, so let me talk about our estimator. So there are basically 3 steps corresponding to the simple, the paradigm of the simple word counting approach. Very well. So the first step is so-called correlation screening. So we're trying to find out which words are most associated with an article that has a positive return. So if we can find those words that are most positively related to these articles, this would be part of the set S, the positive side. And if we find words that are most negatively associated with this, these would be words that also in the set S. So all the words that are in the middle are going to be sentiment neutral. So this step requires basically 2 tuning parameters to decide which word belongs to which set. And then we're going to estimate a topic model and estimate in particular O plus and O minus. And turns out all we have to do is to basically run a regression of the word count or word frequency vector onto some pilot estimate of the sentiment score PI in sample. And we use the rank of return in the training data set as a sentiment score in sample. This is not the most accurate estimates of PI, but we don't need the most accurate estimates of PI. As long as our PI hat is correlated with PI, our trading strategy is going to be justified. And finally, we're going to score new articles using maximum likelihood. And there's only one parameter unknown, which is sentiment out of sample. So it's very easy to do. All right, so let me skip all those details and then dive directly into the empirical study. So we're going to have about 10 million news articles after cleaning, and we removed all articles that have no stocks tagged and all articles that have more than one stocks tagged. All right, so this is kind of the intensity of news articles within the day. And as you can see, before market open and after market close, there's lots of news that we'd like to analyze. All right, so data cleaning becomes much easier, and because of those packages in Python, and we didn't do anything else but following these standard packages in Python. And it's important to mention there is a limitation of the bag of words approach we're essentially taking here, as it ignores the context, like negation, like negative words, etc. So, but the point is, we probably don't need to take into account the context to be competitive for return prediction, because both N.L.P and return prediction are very noisy problems. So you cannot hopefully completely get an accurate estimates of anything. All right, so now let me discuss our training and the testing procedure. We basically have a 15-year rolling window for training, 10 years for training, and 5 years for validation. And we have a testing sample. We use our model once, we retrain our model once per year and use it for the entire year. All right, so let me discuss our training strategy. So we start our day at 9:30 a.m. and close it the next day at 9 a.m. All right, so we leave 13 minutes just for traders to be ready to kind of look at the model instead of using all news. All right, so clearly we're only going to trade at the market open. So we completely, we're not basically competing with high frequency traders intraday, but the overnight news are quickly, captured by our trading strategy. And so this is so-called the day one trading strategy, where we analyze news that occurred day 0 and trade at market open at day 1 and hold the portfolio only for 1 day and rebalance only at the open. And the next strategy we tried is day 2 strategy, which is we analyze all the news at day 0, do nothing on day 1, and only trade on day 2 open. So, if you really worry about transaction cost, market impact, etc., you can actually trust, a Sharpe ratio for a portfolio between day +1 and day +2. So we also report day -1, day 0, and day -2 portfolios. Those are infeasible portfolios. They are created just to help us understand the problem and provide benchmark. So this is the estimated negative words and the positive words. And as you can see, they are self-explanatory, right? So it's self-evident that these are very negative and the rest are kind of positive. And of course, positive words are actually more challenging to extract from the news, because news reporters typically would like to, write about a negative story to make more attention. But clearly, these words are self-evident. So now getting back to the IBM example, you can see clearly that after we kind of get rid of all the words belongs to set N, so there's basically 5 words that contribute to a sentiment score. Our sentiment score is below 0.5, so it's a negative news article, and clearly the price is trending down. All right, so now let's talk about a more systematic trading strategy where we buy 50 stocks with highest in sample sentiment score and short 50 with the lowest. All right, so we're gonna evaluate the performance. Based on this trading strategy. All right, so this is the cumulative returns of such a trading strategy. And let's focus on the bold black curve. That's the long short equal weight trading strategy with a Sharpe ratio 4.29 and average return 33 basis points per day. So this does not take into account cost, which we're going to do towards later slides. All right, so clearly both the long side and the short side are making profit. I mean, we kind of turn the turns the axis upside down for the negative part. So the lower the better for the short side. All right, so now if you regress the cumulative returns onto some existing low frequency trading factors like Fama fringe factors, you'll find that our alpha are basically equal to the average return, which means that these traditional strategies that are low frequency, they're actually orthogonal to the high frequency trading strategy, which is not surprising at all. All right, so we also report day -2, -1, 0, 1, 2, and all the way to 10, -10 portfolios. And as I have said, day 0, -1, -2, etc. are not feasible. But you see a high Sharpe ratio, which means that in terms of correlation, our measure is pretty good. Day -1 have a high Sharpe ratio. It means that the news we analyze, many of them are actually redundant or repeated news. So, but clearly, news are the speed that news got incorporated into prices are about for 3-4 days. Because all the other portfolios are not making any profit, but you don't see any reversal either. So which means that the news are actually informative, All right, so let me conclude with a comparison study. Here we are using Ravenpack sentiment scores, the same trading strategy, and also word counting dictionary-based approach. So we compare our approach with these two benchmarks. All right, so this slide report the performance, and the top one is ours, and the second line is Ravenpack, also equal weight. And you can see that the performance of Ravenpack strategy becomes less attractive after 2015. There might be two reasons for that. One is Ravenpack was widely subscribed after 2013 or something like that, which kind of diminishes its its alpha. In addition, we are using the latest version of Ravenpack, so it's not clear to us which part of the sample is really in sample and which part is out of sample. So it is possible that after 2015, that is really out of sample for Ravenpack. So we have no idea. And the logarithmic McDonough approach has a much lower Sharpe ratio, and it cannot be transaction cost based on our analysis later on. So I have to skip all the other analysis. One thing about size effect is clearly, very obvious, which is not surprising, by the way. But keep in mind that we have about 1,000 news per day. So most of these news mentioned companies are actually large relative to the 3,000 news or 3,000 tradable universe. Stocks in the tradable universe. So we're actually having less of a problem about trading small stocks in this exercise. All right, so let me skip this slides and let me skip this analysis. And I think I have no time to discuss how we handle transaction cost. So because we're not dealing with any optimization, and which gonna make our analysis more opaque. So we actually use a very simple trading strategy that controls the amount of turnover we'd like to have, so that this would lower the trading cost. And after we have done that, the net Sharpe ratio taking care of the transaction cost is about 2.3. And I'm pretty sure that this can be improved because we are using equal weighting essentially. We just kind of do a very naive approach to kind of control turnover cost. All right, so I have no time to discuss the theory, the statistical theory side about our paper, which actually shed light on, constraints, the limitation, the statistical limitation of a perfect recovery of sentiment score. So obviously we need a large sample size, but we need a kind of a relatively small dictionary, etc., to make this, approach, feasible. All right, so let me conclude. So in this paper, we introduce a new text mining model to extract sentiment information from text. It's supervised, it's high dimensional, and so we provide theory, and it's a transparent, a white box approach. All right, thank you very much.
Thank you, Dacheng, for a great presentation. We have, so if someone wants to ask questions live and want to raise their hand, feel free to do it right now. I have a couple of questions coming in from the chat. The first one is from Vicky Tang, and it's asking, can N.L.P. methods differentiate from do not likes and likes, right? So negations and not negations. Do you directly take care of this?
Not really, because once you take care of the one level negation, you have to worry about double negation and things like that. So this approach does not take care of the negation at all, but the model allows for error, right? So this is a multinomial model. So it allows for a negative words showing up in a positive article and a positive word showing up in a negative article. So we do have, just like any statistical model, there's definitely errors allowed. So the point of our study is that even if you don't take care of negation, even if you don't take care of the contact information, purely about which words showing up in this article already can do pretty well in a natural language processing. There's no reason to diminish any impacts or potential using contextual information, and this is also something that we are working on. But I just want to say this is a benchmark, and it's a transparent benchmark.
Perfect. So, and I also have a couple of questions. So, one question I had is, at what kind of frequency do you have the majority of predictability using text data? Is it like I see that you guys are doing mainly like daily, but do you have any predictability if you start getting into 2 days, 3 days, 5 days, and so on and so forth, or do you start losing the predictability at that stage?
Right. So this is an excellent question, and you can see it from this plot. Based on the portfolio performance, clearly there is a predictability that we can harvest up to day 2, and after that, basically news information got fully incorporated into prices. And even if you are predicting like 5-day returns, most of the predictability, most of the profits come from the first 2 or 3 days.
But you should be. Have you tried to do any sort of kind of see the results were heterogeneous by, for example, company size? In principle, you expect that the larger companies are traded way more often, so the news is impacting into prices way quicker compared to smaller stocks, for example.
This is exactly what we do here. Thanks for mentioning this. So here we're measuring, if we were to trade right after 15 minutes, 30 minutes, day 1, day 2, how much profits we can make for big and small companies. And so for the big companies, we start with like 10 basis points per day. And for small companies, we start with 50 basis points per day. And as you can see, the performance dramatically dropped for the big companies and quickly diminish after day 2. So exactly as you mentioned, those big companies have all the attention. That's why you expect the news are actually got incorporated into prices. And also many of the news are kind of expected for the bigger companies because they have more coverage by analysts.
Okay, then we have a question from Elliot who's saying, have you been monitoring things to see how long after the release of your paper do you see this strategy stops working?
Oh, okay. So, I don't know when is the time that we should, start worrying about this. But we do look at, we do have done, we definitely have done analysis after this paper have been published. And we have also tried different data sets. Instead of Dow Jones Newswire that we're using, we also tried Thomson Reuters, and we also tried international stocks, etc. So those evidence, they all kind of provide a very positive, clear, gains with portfolio strategy that use N.L.P signals, which we're gonna clearly, present some of these results in later studies.
And I have a question for you, and this is kind of related to the, you right now you're working with so many stocks. You have to deal. I know you guys are taking care of trading costs, but then you start getting into this business. Are you trading at which beta spread or between them? Like what exactly is the execution price? But have you tried to do something along the lines of what you do in your other paper, the empirical asset pricing by machine learning, where you basically try to predict the index by just predicting the future returns of the individuals? This would allow you to have much less trading, right?
So that's an excellent suggestion. So honestly, we haven't done that. One reason is, as you can imagine, we have only 1,000 news, companies, that are mentioned. And, we probably can look at SP 500, but we cannot look at, other companies, other indices or pharma French portfolios, which are made of the entire universe of stocks. This is an excellent suggestion. We should look at SP 500. By the way, we get rid of all the news that have no stocks tagged. We could have used those news and label them as SP 500, and this might also improve the performance.
Okay, then we have last question coming from Ohima. It says, can your framework be adapted to any trading news model?
I don't know exactly what trading news model you have in mind, and but our model is really modular. So this is actually one big advantage of our approach. So we have basically two kind of modules here, right? So one is the return probability structure, one is tax probability structure. You can certainly add some other trading structure to it that deal with the cost. Right, so our goal was to make the least number of assumptions that abstract this notion of sentiment out of news. And I think these two assumptions are the least requirements one would have to make to extract sentiment and also justify why you are estimating sentiment, not something else.
Perfect. Well, thank you so much, Dacheng, for your time and for the great presentation. We have the next speaker is going to be Marina Niessner, who's going to present the paper Fake News.
Right, here we go.
Marina, you have 25 minutes.
Sorry. Continue.
It says that it's I can
share.
It's starting to share the screen, but it is failing at doing it so.
Okay, 1 second. Let me start this. No, we tested earlier. Okay, let's see.
It always, even if you tested earlier.
Can you guys see that?
No. Oh yeah, now we can see it perfectly.
Okay. Slideshow play from start. It's full screen.
Yeah, it's great.
Thanks. Okay, perfect. So thank you very much for having me in this virtual seminar to present the paper. So this is joint work with Shimon Kogan and Toby Moskowitz. And as some of you might know, I'm back in academia, so I'm visiting Yale School of Management this year. So let me start with the motivation for the paper. So there is a large literature in finance that looks at how trust affects financial markets. And there's also an extensive literature that studies empirically how it looks at stock manipulation. And it usually looks on sort of direct effects on stock manipulation, sort of looking at, for example, how spam emails, touting different stocks affects those people's trading. What our paper is going to do is to look at sort of a broader spillover effect of fake news on sort of general deterioration and general trust in financial markets. In particular, we're going to look at how people's awareness of presence of fake news will affect their trusts in news that are most likely non-fake, kind of more general news. And sorry, there we go. So what we're going to do, we're going to answer two questions, sort of a main question and a follow-on question. So first of all, we're going to look, as I mentioned, other spillover effects from fake news on non-fake news. And what we're going to do, and I'll explain that a lot more in detail in a second, we're going to use a shock on people's awareness of presence of fake news from an SEC investigation. And then kind of to follow up, we will look whether this presence of fake news and these effects are a little bit broader than just the scandal that we're looking at. So we'll look at whether we can identify fake news more broadly on social media or like knowledge sharing platforms that I'll talk about in a second, and what effect they have on financial markets more broadly. So first, let me start by talking about this kind of main question, which is the spillover effect from fake to other news and people's trust in them and their reaction on financial markets. So the data that we're going to be using here is from Seeking Alpha and Motley Fool. So those are the two largest what's called knowledge sharing platforms out there. So from Seeking Alpha, we'll have data from 2005 till 2015, and from Motley Fool from 2009 till 2014. And what's nice about those that social media is if you look at more conventional media, despite certain claims, there's not that much sort of truly false news out there. Whereas while these networks or some platforms are often kind of sort of moderated, they're usually not moderated for content. So that lends itself quite nicely for people to exploit that and to try to spread kind of false information. And what we're going to exploit is a scandal that occurred on Seeking Alpha and some of the other platforms. So this happened in 2014, or it came to light in 2014. So it turns out that in 2013 and 14, quite a number of small companies were hiring PR firms to contact authors to ask them to write promotional articles about these companies on these social media platforms without disclosing the payment. And one of the authors that they contacted was Rick Pearson. And he, instead of just saying no, he went undercover and he documented communication with these platforms, with the PR firms, with these companies, and with other authors, and then turned over the evidence to the SEC. And SEC followed with 3 quite large lawsuits against the individuals, the PR firms, and some of the companies. So the first one was end of 2014, and then there was a follow-up in 2017 and 2018. And just to give you an example of what a kind of fake article or some of the articles that were caught here look like. So at the top, you see an excerpt from a Seeking Alpha article. So in September 2013, so this is way before kind of the scandal came out. So it says Biozone has developed a new method of drug delivery, QSUMs, that provides, improved efficacy, reduced side effects, and lowers costs. This technology will allow Biozone to reformulate and sell certain FDA-approved drugs at reduced costs, etc. Then, as you see below, this is an excerpt from the SEC lawsuit that was filed in 2018, and they're referring to this particular article and the author, Keller. And they say Keller misleadingly stated that company A, which is Biozone in this case, had a formulation ready for testing to be brought to the billion-dollar injectable drug market. Yet, as Keller knew, as of summer 2012, all R&D efforts have been shut down without successful formulation. So this is an example of a truly misleading factual sort of misstatement in this article. And so just to give you an idea of the timeline, because that is something we'll be widely exploiting for this experiment, is, so this is from Galena Biopharma. That is one of the main companies that was involved in this scandal and in the lawsuit. And as you can see on the y-axis, we have the stock price of Galena, and this is from, I guess, early-ish 2013 to early-ish 2014. And so this graph was generated from data gathered from an SEC lawsuit. So these are sort of articles that they highlighted themselves. So there were in green quite a few fake articles coming out from mid-2013 to end of early 2014. And then you can see sort of the price was rising accordingly. And then early 2014, a bunch of insiders started selling. And, and that's around the time where Rick Pearson kind of was involved and turned over his evidence to the SEC. And so in red crosses, you can see this was what are called expose articles. So these are articles where, and some of them were in the Wall Street Journal, where kind of people started saying, okay, there's something going on here. It looks like there are fake articles on these websites. And it was sort of a nice time period. It's from very beginning of February to end of March 2014. So we're calling those 2 months as expose period, and it ended with Galena actually filing a security filing saying that they are under SEC investigation. So this is a time period where people who are reading articles on these websites suddenly got this quite exogenous shock to their awareness that, hey, even though you may have suspected that there's some false information here, that's actually the case. And what we're going to do is we're going to look at 6 months before and 6 months after the scandal to compare how people react to general news on these websites. So while they're now aware that there are a couple of, well, I'll tell you, like 100 some fake articles that SEC like specifically caught by almost 40 companies, there are obviously, like, there are other Seeking Alpha articles that are out there, and our question is, how do people react sort of more broadly to an average Seeking Alpha article? And when we say react, and this is why financial setting is so nice, we can look directly at their trading activity in the sense that we can look at trading volume around the publication of these articles to see how it changed from before to after the scandal. And so what we're going to do before we look at the change, we want to establish that seeking alpha articles or monthly fold articles even matter for trading volume, because obviously if they don't matter for trading volume, then looking at changes doesn't make sense. So our first table is going to be sort of our baseline. This is an effect on daily trading volume around an article. And we choose to specifically look at trading volume. If you look in our paper, we also have results for return volatility. The nice thing about trading volume, it actually captures the act of trading. If you look at prices that, I mean, we're still in asset pricing, don't exactly know how prices and trading volume co-move, but prices is sort of new information. Whereas if you kind of read a seeking alpha article and you act accordingly to what it says, then that should affect at least trading volume. So on the left-hand side, we have abnormal trading volume in the 2 days on the day off and then 2 days following an article. And on the right-hand side, we have whether that was an article actually on that day or not. So you can see in the first column that there is actually a strong effect for a seeking alpha article and a monthly full article on trading volume. Then we, in the second column, we control for some potential confounding effects, which is abnormal trading volume on the prior day. If there was an SEC filing, press release, other media is Wall Street Journal and New York Times, just to try to capture kind of any other events that could be happening at the same time. And we can see that the effect of the article does diminish, which is what something would expect. And then we also split by firm size and retail ownership, and maybe not surprisingly, the effect is much stronger in smaller firms where the sort of information environment might be more opaque or there's just less news out there, and also for high retail ownership. So here we established that an average article on these knowledge sharing platforms actually seems to have an effect on abnormal trading volume in the markets. So next we want to look, as I mentioned, how does the scandal affect that? And so here we can see controls. I'm gonna suppress they're in our papers, but I'm gonna suppress here for expose reasons. So here we're looking at, the first column is again, how an article affects the trading volume. And we see that this is larger for small firms. And this is 6 months before and 6 months after the scandal. And then here we look, what's important in this table is the interaction term. So while there is an overall positive effect from an article on trading volume, the effect is smaller in the 6 months after the scandal. And that drop is higher for small firms. And here we control for abnormal trading volume, press release, SEC filings, etc. So this to us suggests that there was an overall decline in trust in the way people react to seeking alpha articles and monthly full articles in the time after the scandal than before. Of course, there are lots of, we also see similar returns if we look at return volatility. There is less return volatility around those articles. And just to look at kind of what this looks over time. So in the regression, we'll look at 2 days sort of after the article. How does it look kind of overall? So here we're looking at trading days, and at 0 is when the article comes out. So if you look, this is sort of a nice placebo test or falsification test. In the days leading up to the article, there is not a difference in trading. So this graph is basically this interaction term. So we can see that there's not a difference from before to after the scandal in the days leading up to the article. Then there is a drop on the day of the article. It's not statistically significant. And then there's a big drop in the days following, and it lasts for about a week or close to 2 weeks, and then it sort of goes away. And the reason we looked at this graph is to see whether the volume catches up, in the sense that it could be that people trust the articles less, they maybe take more time to verify the information, and then the trading goes up. But it looks like no, the trading is lower kind of after the scandal, and it sort of doesn't make up for that. And the kind of result, the takeaway from this graph is that there's just each news article has less impact on people's trading or people's trust. Of course, it could be that other things happened at the same time as the scandal. And we're going to look at a couple of things. One is there could be a shock to just, for whatever reason, coincidentally, at the same time, a shock to information environment more broadly. And also it could be that, obviously, this scandal had also effect on authors, and it could be that the types of authors that were writing changed, or the types of stories they're writing changed. And so the drop in volume is not at all driven by the fact that people trust the stories less, but just they react the same, but something else happened. So we're going to try to rule out those alternative explanations. And if you have any others you would like to suggest, please feel free to email me or say that in the chat. So the first one is to look at any other shock or other shocks that happened at the same time that could be affecting the information environment. So what we do is we look at the same interaction, except we interact now not just the article with it 6 months after, but we also interact any SEC filings or press releases or media articles, which is Wall Street Journal and New York Times. And we can see that there was no change. So I think that has this result is nice for two reasons. One, if there's nothing else happen, let's say, it would be pretty bad probably if we did find an effect from the scandal on Seeking Alpha on the way people react to to Wall Street Journal articles or SEC filings. So from that sense, it's comforting that there seems to be an effect on these knowledge sharing platforms, but there is not a spillover effect to sort of broader news, which would probably not be very believable. And second, it does not appear that this drop comes from some other shock to kind of more news information more broadly. It seems to be concentrated on these knowledge sharing platforms. So the second test we look at, as I mentioned, is to look at kind of how authors and articles have changed. So first, what we look at is how author characteristics, whether author characteristics matter for kind of trust and reputation. So while we found that there is a drop in volume reaction after the scandal, that drop is smaller if the author of the article has more followers or has already written more articles, so let's say established a reputation, or the article talks about earnings related topics where it's probably harder to sort of make up things. And the drop is actually larger if the author of the article discloses an existing position. So people seem to be even more suspicious of any conflicts of interest. So what we do next is we look at how the articles themselves or comments to the articles or the authors changed after the scandal. So when we look at the articles themselves, how they were written, we find that there was no change in analytical cloud or tone measures. I will actually get back to those in a little bit, but these are basically measures, linguistic measures of how analytical the language sounds. Cloud means how assertive the language sounds, which can affect people's tradings, and also tone, positive or negative. So it looks like the articles themselves did not change very much. We did see an increased mention of earnings related topics. And as I mentioned, that is something people seem to trust. So maybe not surprisingly, authors write more about that. Then we'll look at comments that people write on Seeking Alpha to the articles from before to after the scandal. We find no change actually in the number or length of comments. They did become slightly more negative. But more interestingly, and this is, I think, kind of the demonstration of the mechanism that we have in mind, we find increased mentions of work fake and fraud after the scandal in the comments, but no change to mentions the words wrong or not right. And to remind you, this is 2014, so this is before 2016 when words like fake news became very kind of ubiquitous. So this to us, again, it's not approved, but this is corroborative information that the mechanisms that we have in mind, that people just trust these articles less because they're worried about fake articles, might be actually at play. And again, if there's no change to things like that, it's wrong information. And lastly, authors after the scandal, they tend to have on average more followers and also have had written more articles in the past. So it does look like that authors with more reputations are the ones that stay, and authors with less reputation disappear. So now that I showed you all this evidence, you might say, okay, how does that combine with our result that we find? Well, just to remind you, we find that the volume reaction actually decreases after the scandal. But if you look at the findings that we find in the changes to articles and authors, that, for example, increased mentions of earnings related topics, having more followers, basically having more reputations, if anything, should have increased the trading volume. So our results of the decrease in trading volume should not be explained by the changes that occurred kind of after the scandal to the platform. So the last thing I want to look at is just to try to rule out any changes even further. We might say, okay, so far we've looked at 6 months, at all the articles 6 months after and 6 months before the scandal. So you might say, okay, but 6 months, lots of things happen in 6 months and all these changes to authors and articles, etc. Well, can we look at closer to this discontinuity? So what this graph is going to show is this effect of the days around the article, but if we only look at articles 1 week after, 2 weeks after, etc. So if we can see that if we narrow it down to 1 week after the scandal, we have very few observations, obviously, so we're losing power here, but we do see already this negative effect. So even a week after where there probably hasn't been too much change yet, there is already a drop in trading volume. If we look at 2 weeks after, again, we still don't have many observations, but it's still there. I know it's sloping down, but statistically it's basically flat. 1 month after, we're already getting enough observations to have power. 3 months after, 6 months after is what the results we showed you. And if we keep going, it actually tends to disappear after about a year and a half. So after a year to a year and a half, investors seem to have forgotten about all the scandal and react to trading, to these articles trade as they used before the scandal. So far, I've shown you kind of spillover effects from these awareness to fake news on people's trust more broadly in general news and how that spills over into financial markets. Now, the question is this basically, what is the impact of false content more broader than beyond just the scandal? And for that, we're wondering, can we actually identify fake news to look outside of the scandal time period? So just to say fake news, to define what I mean by fake news, that is news written with an intent to deceive. I know nowadays there are many definitions of fake news. So the idea is basically if I say that the price of Apple will go up tomorrow and it goes down, that is not fake news. That's me just expressing a wrong opinion. But if I know that the price will go down, yet I say that it goes up, then I sort of specifically want to deceive the reader. And that is what we define as fake news. And the reason we do that is because the way we're going to identify fake news is using James Pennebaker, who is a linguistic psychologist, a famous linguistic psychologist at UT Austin, who has worked with the FBI before, was profiled in New York Times, etc. They developed a methodology in a software called Luke. And what Luke does is you pass it a text, and it provides a bunch of linguistic measures, one of them being what's called an authenticity score, which is a combination of several linguistic measures to detect whether people are lying. For example, when we lie, most of us don't like lying. And so we use fewer self-referencing words than at the time periods where we don't lie, and also fewer insight words, etc. Just to give you an idea how it works, so this is an example from Jamie, actually. So when Anthony Weiner was lying, he said, we know for sure I didn't send this photograph. We don't know where the photograph came from. We don't know for sure what was on it. Whereas when he was telling the truth later, he said, I would like to make it clear that I have made terrible mistakes, that I have hurt people I care about the most, etc. So we can see kind of how the language changes, and this is the type of methods that Jamie uses. One big question is he did not develop it for finance, and often N.L.P methods are extremely subject specific. So we need a test sample. So we got lucky that we went contacted Rick Pearson and the SEC. They shared 171 for sure fake articles with us by 20 authors and 47 firms. And we also were able to obtain 334 articles by the same authors that were not fake. And so when we compare this authenticity score, this is our test sample, we actually find, so the higher the authenticity score, the more authentic the language sounds. We actually find that non-fake news has a much higher authenticity score for the same authors than fake news. And it's actually similar than to kind of all Seeking Alpha articles. So with this in hand, we verified the method. You can read in the paper, there's a lot of other stuff. We basically convert this authenticity score to probability of being fake or non-fake. And then we look at how, now that we have a much broader sample of candidate fake articles, we look at how fake news can affect financial markets more broadly, in the sense that, do they get fooled? And we separate companies into small firms and like medium to large firms, partially because those firms tend to have very, very different information environments. And here, this is my last result I'm going to show you guys. So on the x-axis, we have trading days. The y-axis, we have cumulative abnormal returns. And red line is when the news article comes out, and we're looking at the difference between fake articles and non-fake articles. So fake articles that this look software and our math identified as fake. And we can look that before the article comes out, the cumulative returns are very similar to each other. And then after the article comes out, after a while, the returns for small firms start kind of rising, and they stay high for about almost 200 days. And if you've looked at other kind of anomalies in small firms, this is not, while this is quite long, this is not terribly long or unbelievably long. The sense is these anomalies can persist for quite a while. And again, these are sort of the bottom 10 percentiles of NYSE market cap. So these are truly small firms. And we see sort of no effect for medium and large firms. And interestingly, the returns actually even for small firms, and if you keep looking further, they go down eventually beyond just zero. So they don't just revert, suggesting that often these, it's not like any random firm chooses to hire people or write themselves these fake articles. So usually the firm is not doing well and sort of eventually comes out. So let me conclude as I'm almost out of time. So in this paper, we do two things. First, we document a spillover effect of presence of fake information out there on people's trust in legitimate news. And in particular, we'll look at a setting on financial markets where we can really measure the left sort of the outcome variable. And we show that that causes people to incorporate these news less into their trading decisions. And just to make sure, I'm not saying that that's a bad thing. Don't know if it's bad that people actually question what they read on the internet, but it's still an effect that's definitely there. And also we show that impact of false content is sort of broader than just identified by our scandal alone, that it's kind of persistent on these social media platforms or knowledge sharing platforms, and it can affect financial markets more broadly. Thank you very much.
Thank you very much, Marina, for a fascinating presentation. We have a couple of questions. The first one comes from Elliot, and I think it's a little bit more on the, not technical side, but it's a more on implementation side. He's asking, why not use a classifier to predict fake news rather than using the Luke measure, or at least you learn the weights on the Luke terms?
Sorry, it means why not use a classifier?
Like why not using just a logic model for predicting the fake news as a as a 0,
okay, that's a good question. We have toyed around with that idea, but then we decided to basically take as much off-the-shelf algorithm as possible. So the idea is, so Luke basically outputs a lot of, as I mentioned, I think over 80 different textual characteristics about the text that you put in. So you could think about using a model, if you have those fake news, to like put your own weights on those kind of characteristics rather than using the software. Again, we try to create as little of a black box as possible. And obviously our testing sample is quite small, and we would be overfitting tremendously. So we chose to sort of meddle as little as possible ourselves into that methodology and just take something that was already there.
Okay, then the second question comes from Francesco D'Acunto, who says, great paper, Marina. Then writes, sometimes we think about deception also when a source of information does not disclose their information fully, but sorry, someone wrote something else, so I skipped the line. When a source of information does not disclose their information fully, not just when they blatantly lie. Would the Luke measure also apply to this form of lying fake articles? That is, do you know if the psychologists think still people use the term we rather than I when deceiving by not disclosing fully?
That's a very good question. I don't, it's a good question. So I believe that they would catch it if the person felt bad about lying. But it's true with lying in general. So even, by the way, this is, since it's a psychological effect, if you convince yourself of your lie, or you're just extremely comfortable lying, then we wouldn't, even this method wouldn't catch it, even if you were factually wrong. Whereas if you're omitting some information, but you're sort of maybe an average person and you don't feel great about it, then you would actually seem like you would change the way you write.
Okay, perfect. And then we have a question from Paul Soder, and this is the last one because we have to move on to the next paper. But he says, great presentation. Is there a way to measure the saliency of fake news article and measure how the words, phrases differ depending on how viral the news went?
That's a good question. Saliency. So saliency, it depends. So we did not look, we would love to measure how viral the news went. And that would be actually, like, we could do a lot more in our paper with that. We did contact Seeking Alpha. They shared with us some kind of how many people read it, et cetera. Unfortunately, they only keep that data for the last year. So not very useful. We measured saliency linguistically. As I mentioned earlier, there's one measure linguistically that Luke has, which is clout. So how forceful the language is. So we played around with that a little bit, but no, unfortunately, we cannot measure how viral these news have gotten. We would love to have it.
Perfect. Well, thank you so much, Marina, for the great presentation, and thanks to the audience for the great questions. Let's move on to the last paper. It's presented by my colleague Xiaofei Zhao, and the title is Neglected Risks in the Communication of Mortgage-Backed Security Offerings. Xiaofei, please take it away whenever you're ready. You have 25 minutes.
All right. Thank you, Alberto, for including our paper in this panel. This is a joint work with Harold Zhang and Feng Zhao from UT Dallas. So let me first of all give you some motivation for this paper. As we all probably know, the residential mortgage-backed security is a key asset class in the 2008 financial crisis. Right? From a theoretical standpoint, this security market has the following features. It is a security market with significant financial innovation, but with investors neglecting some important risks, and which lead to a very fragile security market that collapses after the investors realize some risks later on. To understand the source of risk, the issuance process for these securities provide a very nice setting because we are able to examine the information set that's accessible to the investors when they are purchasing those securities. So we are able to identify the source of risks that might be neglected when they were purchasing the security. Now, the issuance process is also important for different reasons. For example, it provides very critical information on the risks and valuation of those securities. So the key question we ask in this paper is whether we are able to extract and identify some tax risk measures from the written communications in those issuance process, and whether investors neglected some of the risks, and what are the consequences of that. To answer the question, we compile a very comprehensive data set of RMBS deals with both the deal characteristic issuance communication documents and also the holdings of those securities from institutional investors. And we take 3 steps to answer the questions. In the first step, we try to apply different text analysis tools to understand the content of these written communications. In the second step, we try to establish that some of the measures from the textual analysis can actually be good proxies for the textual risks in those deals. In the last step, we try to link the textual risks we identify from the textual analysis to the holdings of the investors. We examine whether the investors ignore the risks or not. So to give you an overview of the findings, the first set of findings, we find that indeed there's a significant variation in the communication content. If we divide the issuance process into 2 parts, one is the pre-issuance process, the other one is the final communication, which is in the form of final prospectus. We find that in the pre-issuance process, there's a big variation in terms of textual information provided to the investors versus the numerical information provided to the investors. And in the final prospectus, there's a big variation in uncertain words used in different sections. So our second set of findings then link those textual measures to the asset quality or future losses of the underlying loan pools backing those deals. And we find that when the pre-issuance communication content are more textual heavy, or when there are more uncertain words used in the risk factor sections, the future losses are much higher in those deals, suggesting that these textual measures can be good proxies for textual risks. And our third finding is then trying to link those textual risks to the holdings of the institutional investors. We found some findings that supporting a sharp contrast in attention paid to the textual risk by the investors. For example, as a group, mutual funds, they tend to hold less. They are more cautious. They tend to hold less of the deals when there's a higher textual risk in the form of more textual FWP or more uncertain words in risk factor section or less numerical information provided in FWPs. In contrast, insurance companies and mutual funds as a group, they seem to ignore such textual risks. And as a result, what we find is that insurance companies and pension funds, they suffer more losses, but they are not compensated for the kind of losses they are suffering in the future. In other words, these future losses are not reflected in the pricing that when they were purchasing the securities. So overall, the paper discovers that there's a significant textual risks, and that's an important source of risk that's being neglected by the investors preceding the financial crisis in 2008. And therefore, investors are suffering large unexpected investment losses because of the neglection of this important source of risks. And our paper links to several lines of research. On the first part is, we provide evidence on, where the neglection risk is coming from. Whereas some other papers in the literature, for example, they focus on the security design aspect of this market, and we focus on where the source of risk might be coming from. On the second literature, we try to link to the literature on our MBS by showing that investors themselves play an important role here when they are neglecting the risks. And lastly, this relates to textual analysis of written communication in the fixed income security offerings, and there are relatively fewer studies in this area. Before going to the empirical analysis, let me give you some institutional background that made this study feasible. Now, first of all, the unique features of residential mortgage-backed securities, or ABS in general, is that it's different from corporate securities or operating companies in that there's no management company, right? The most critical part of this issuance of this security is there's a asset pool, and the information about the structure of the deals, the quality of the asset pool are most critical to investors. Therefore, when we try to link the textual content to identify textual risks, observing the underlying asset value changes is critical. So we are able to do this because of this asset class. Secondly, there's some regulation changes in this market that made the data available so that we are able to collect the pre-issuance communication documents in a systematic fashion. So prior to December 2005, the sale of those securities are typically used in term sheets, but the issuers are not required to file those term sheets to the SEC. Therefore, we won't be able to observe the pre-issuance communications in a systematic fashion. But after December 2005, the security offering reform requires that as long as there's a written communication between potential investor and the underwriter, then that document needs to be filed to the SEC in the form of a writing prospectus. In addition, the regulation AB passed in January 26 required the ABS issuance also subject to the rule under security offering reform, and that made the data available on SEC website. So these are the two institutional regulations that made the data available. So our sample are collected from several databases. It consists of non-agency RMBS deals between 2006 and 2007, right before the financial crisis. As I said, right, it started in 2006 because of the regulation. It ended in 2007 because after that, the market is basically gone. Right? Therefore, our empirical analysis are mostly identified by the cross-sectional variations, and we also control for time fixed effects because this is a very unusual time period. So we are really relying on the cross-sectional variation to identify the results we have. On the data on the deal characteristics, such as the FICO score, loan-to-value ratio, documentation level, those traditional variables used in the analysis of RMBS, we rely on Bloomberg. And the data on the issuance documents, both the free writing prospectuses and the final prospectuses, are collected from the ADGA. And finally, the data on the institutional holdings are obtained from the Thomson Reuters Emacs solution. So that's where we are able to observe, who are buying those securities and how much they are purchasing. And our full sample is around more than 1,700 deals with about $1.5 trillion in the underlying mortgage loans preceding the financial crisis. And the sample size varies depending on the data availability in our analysis. Right. So let me talk about the textual analysis part of the paper. That's the theme of this panel. On the pre-issuance documents, we focus on free writing perspectives. And those written documents are quite unstructured in the sense that as long as there's a demand or communication between investor and issuer, that needs to be filed to the SEC. So it can be any detailed loan level data, as later on we'll call this loan tape data, or it can be any structure or collateral term sheets, or can be any updates to the preliminary prospectus. So for this reason, we do not try to analyze the content too much. Instead, what we try to focus on is we try to focus on soft versus hard information, right? Soft information in the sense of how much words are used, how many words are used in this communication process. And hard information is how many numbers are used, basically, right? So we classify the FWPs into two types, right? The long tape FWP is basically, you can think of as a big Excel file with information on individual loans, whereas the textual FWPs can be anything in written in words. And I would like you to pay attention to, for example, the key difference between the two types of FWPs can be seen from the, for example, alphabet to number ratio, or you can think of that as a word to number ratio, right? So in long tape FWPs is dominated by numbers. So word to number ratio is on average 0.5, so it's much lower than the textual FWP, which is 51, the word to number ratio. Another point I would like to mention here is that you can see the number of alphabet tokens seem to be similar across long tape and textual FWPs, but that's not because of there are too many words used in long tape FWP. It's because some of the category variables in long tape are used in words. For example, when they talk about the occupation status of a loan, they can say that's owner occupied or investment, right? So these are still quantitative information, but we're showing up in words, right? So what we are trying to capture, measuring those content is then we are going to count the number of tokens in textual FWPs and then count the number of tokens in long tape FWPs as the two measures for the two different types of pre-issuance communication content. Right. And now we can move on to the final prospectus here. Now, final prospectus are more standard. And because we are talking about fixed income securities here, we focus on downside risks. And our benchmark proxy for measuring downside risks are the uncertain words from the Lockran and McDonough uncertain word list. But importantly, as I will show later, is that to interpret, uncertain words are not necessarily equivalent to risks, right? It really depends on the context these uncertain words are used. Therefore, we have two different ways to enrich our economic interpretation of our uncertain words measure. The first one is we try to break down the document into individual sections. For example, we're able to extract the table of contents, then we can locate the pages of different sections. And we focus on the four main different sections: the risk factor section, a mortgage pool section, a description of certificates, and then summary. Right? So that's the first way of trying to enrich the economic interpretation on certain words. And as I will show on the next slide, it really can have different meaning when used in different sections. The second way we try to enhance the economic interpretation is we try to conduct the topic analysis for risk factor so that we are able to further understand what kind of risks are discussed in these risk factors. And we can associate uncertain words usage to those topic discussions. So let me show you the uncertain words usage summary here. The uncertain word list from Lockran McDonough has 2,600 words in total. However, if you look at the whole supplement, it's really the two words stand out. The word may and the word approximately account for 25% alone, these two words, right? So, and very interestingly, if we further go to the individual sections, we can see in the risk factor section, it's really dominated by the word may. It's about 25%. Whereas in mortgage pool section, the approximately, it's dominating the uncertain word use, about 27%. This contrast alone suggests that in risk factor section, because we know these are purely about the risk topics. So that means the uncertain words used in risk factor sections are mostly likely to reflect risk topics, and I will show some examples later. Whereas in contrast, in mortgage pool, the uncertain words approximately is used freely for numerical approximation. So that may not have the equivalent interpretation of risks as in risk factor section. So this suggests that indeed understanding the context where those uncertain words are used is quite important, right? And then if we look at the summary stats on the uncertain words, for the prospectus overall, there are more than 1,200 uncertain words used, but we can see it's dominated by uncertain words used in the risk factor section, right? If you look at a correlation between the overall prospectus supplement with the sections, we can see the correlation is highest between the overall prospectus and the risk factor section with 0.62. So these are the uncertain words summary on the prospectus. And now let me give you some examples on what kind of risks they might be talking about in those sections. For example, the first sentence here suggests that reads as follows: as a result of this less stringent approach to underwriting, the mortgage loans the mortgage loans purchased by the trust may experience higher rates of delinquencies, defaults, and foreclosures than mortgage loans underwritten in a manner which is more similar to Fannie Mae or Freddie Mae guidelines. So this one is more about the underwriting guideline of the mortgage loans may not be as stringent as the traditional guidelines, right? And then second one is increased use of new mortgage loan products by borrowers may result in decline in real estate values in general. Okay, so these are the type of examples we have, and you will see more if you read the paper. Now, our next step in the topic in the analysis of the final prospectus is to conduct some topic analysis. Here, what we are trying to understand, what kind of risk topics are being discussed in the risk factors. So we use the standard topic analysis to LDA. So that's a probabilistic model that's trying to decompose a collection of documents into a number of topics. Right? So the input here would be two things. One is the collection of documents. The other one is we need to input the number of topics to this algorithm. Now, the assumption here is that each document has a distribution on n different topics, and each topic has a distribution on the word tokens. In our case, in order to determine the number of topics that best describes the risk factor sections, we try the n from 5 to 50, and we choose the optimal n when the likelihood of the data being observed, given the number of topics, is highest. And also we require the topics have very little overlapping. And the second input for our topic analysis stats, we use the phi-gram, which is basically a sequence of 5 adjacent words together. This is very important because in our setting of mortgage-backed securities, the words are quite homogeneous. So if you only use unitoken or bigrams, then you will see that among different topics, it's very hard to differentiate, and it's very hard to interpret different topics. So using phi-gram actually preserve the sequence of the words, so that enhances the economic interpretation of the individual risk topics. Right? So our main result on the LDA topic is that we find that 15 topics are best for describing the individual risks in the risk factor sections. And the correlations of the words among the topics are actually pretty low, indicating that indeed using phi-gram is very good for separating the documents into individual topics. For example, the non-traditional underwriting risk can be associated with, say, Fannie Mae, Freddie Mae underwriting. Right? So this is what I showed you before. And arms risk can be associated with aggregate principal balance adjustable rate. Right? And then, as I said, we also associate uncertain words usage with the individual topics, and we group the topics into 3 broad categories. The first category are related to the mortgage loans and borrowers. These are more about the non-traditional underwriting, non-traditional mortgage products that borrowers are using, so on and so forth. There are 6 topics in total, and about 44% uncertain words are used among those topics. The second category is about the security structures. There are about 28% of words used in 5 individual topics related to deal structure, lack of liquidity in those new securities, so on and so forth. And then the standard mortgage risks about uses about 28% of the uncertain words. All right. So now after constructing all the textual measures, we try to establish first result is that whether we can extract some textual risks from those textual measures, right? So our analysis is basically link the communication content to the future losses of those deals. So on the left-hand side of those regressions, we are going to put the cumulative net loss of those deals as of December 2010 on the left-hand side. On the right-hand side, we are going to put both the FWP content and also the uncertain words we constructed from the final prospectus. One thing to note here is that the cumulative net loss captures not only the delinquency or the default rate of those underlying loans, but also captures the loss given default. So that's a good measure for the quality of asset pool. So our first results suggest that basically, if you focus on, for example, column 1, the overall uncertain words used in prospectus are significantly and positively correlated future losses, meaning that more uncertain words in the prospectus, higher future losses. If we move on to the textual FWP, we can also see that the more words used in the pre-issuance documents, the higher future losses the deals will experience. And then among the individual sections, we can see, if we, for example, focus on column 2 or column 6, we can see that the risk factor section is really the main driving force for the uncertain words used in the prospectus to predict future losses. And in terms of economic magnitude, it's quite significant as well. For example, one standard deviation increase in the uncertain words in the risk factor section is associated with 1.18 percentage points higher deal losses in the future. And this is close to 10% of the average deal losses in our sample. So that means this indeed, those textual content represent significant textual risks. And we also look at the pricing, right? The question is whether investors take those risks into account. If they take those into account, then there's been no issue. They're just buying junk bonds by paying a low price. So here we use 2 textual risk indexes that we identified from the previous slide. The first index captures the risk factor in the prospectus, in the risk factor section certificates, textual FWP and loan tape. And then second index captures the overall prospectus and then the FWPs. Here, what we see is that we try to use a match analysis to understand this. So we, for all the deals in the for all deals in the high textual risk index subgroup, we match with another deal in the low textual risk index subgroup, and we compare the differences. And overall, you can see here for deals that are in the higher textual risk index, they do not have higher yield spreads. Therefore, this results overall suggest that investors are not compensated for the loss relevant components in the communication content. Right? And then we also look at the institutional holdings. Right here, we focus on the AAA securities, and then there are 2 groups of investors we focus on because these are the majority of the institutional investors in this database: mutual fund and insurance companies and pension funds as another group together because their regulatory, capital, or investment objectives are similar. And then our analysis here is to regress the holdings on the textual risk, controlling for other things. The idea is that where the investor pay attention to the written communication can be reviewed from their sensitivity of the holdings to the textual risks. Right? So here are the main results on where the investors pay attention to those textual risks. On column 1, 2, and 3, we can see that mutual funds in general, they are more cautious. Their holdings decreases when the textual risk index increases. And we can see it is very important when the risk factor section on certain words increases, they decrease their holdings. Whereas in contrast, insurance companies and pension funds in general, they are insensitive to those textual risks, indicating they probably are neglecting those risks. Right? And then the next 2 set of results, then we show that at the security level, the losses of insurance companies will be higher. So we regress the losses at the security level on mutual fund holdings and insurance companies. And we can see that here, in general, insurance company holdings are positively associated with the losses. And that's more of the case in the subsample when the textual risk is higher. Right? So that suggests that the textual risk is a driving force for the losses in insurance company holdings. And our last set of analysis shows that the yield spread between the 2 group of investors are actually not very different from each other. And you can see here. So suggesting that the insurance companies, although they suffer losses in the future, but in pricing, they were not able to take that into account. So overall, what we document is that we document the source of risks that investors might have neglected but have been disclosed to them in this important asset class preceding the financial markets. So we conduct a lot of text analysis. We show that mutual funds tend to pay more attention to textual risks, while insurance companies, they are inattentive. And as a result, they suffer more losses. All right, so that's what I have, and thank you very much.
Thank you, Xiaofei, for the fantastic presentation. I have a couple of questions. So the first one, I guess it's more on the policy side. So what do you think these results kind of entail? Do you think that we should just have that this written communication should be done in a different way? Should we kind of try to quantify this risk? I mean, what do you think is the best way as a policymaker to kind of make sure that these risks are actually taken into consideration? Yeah,
that's a very, very very important and interesting question. We've thought about this, but I mean, there could be different reasons why they are neglecting the risk, right? Because they are even disclosed the risk. So from the theoretical point of view, I mean, the Schleifer's theory would say, they are local thinking investors, therefore they neglect the improbable risks. So even if you tell them these are the risks, they may not be able to sort of capture that. So I don't have a good answer on the policy implication here. Yeah.
I see. And so another question that I have was related on your, so you kind of distinguish between mutual funds and insurance companies, but have you gone deeper into all the types of mutual funds that you have, that we have, or different type of insurance, or have you considered hedge funds, for example?
Oh, hedge funds, unfortunately, it'll be great if we can have that data, but we don't have the Emacs data solution. It's mostly from mutual funds and insurance companies, so we don't have access to the data on hedge funds.
But this all aggregated, or is that the mutual fund level?
Is at the mutual fund level. So we are able to drill into the more detail at the fund level analysis if we want to go down that path. Yeah.
I see. Okay, perfect. I think this takes us to a very natural stopping point. I'd like to take a moment to thank very much Xiaofei, Marina, and Dacheng for the fantastic presentations, and also to the people logging in, the audience. You guys have been extremely active, and the comments, I'm sure, are going to be extremely helpful for the authors in reviewing their papers. And we're going to take a 2 weeks hiatus, exactly because we have the annual conference coming up in 2 weeks, and then you'll receive information from us on the next events that we're going to start having towards the end of November and beginning of December. Thank you, everybody, for logging in.
Thank you, Alberto.
Thank you, Alberto.
Bye-bye.
Bye.